Most people believe that building real wealth requires a six-figure salary, complex trading algorithms, or a massive stroke of luck. Wall Street wants you to think it's an elite game, reserved only for those who can spend 12 hours a day staring at flashing red and green charts. They sell you the illusion of fast money, complex hedge funds, and high-risk options trading. But the reality is far more shocking. Today, we are analyzing the exact data-driven story of how an ordinary corporate employee earning a modest $65,000 a year completely outperformed 90% of professional fund managers. They did this without picking a single individual stock, without checking the markets every morning, and by relying on one single incredibly boring habit. We are going to break down the precise mechanics of this strategy, expose the hidden fees designed to keep you trapped in the rat race, and show you how to implement this system starting today.
Let's introduce our subject, a regular guy named Mark. In his late 20s, Mark felt the exact same pressure millions of Americans face right now. Inflation was creeping up, housing costs were soaring, and his bank account looked virtually identical at the end of every single month. He tried everything the mainstream internet gurus recommended. He downloaded day trading apps, chased speculative meme coins, and tried to time the market based on breaking news alerts. Every single time he made a small profit, a sudden market drop would wipe it all out, leaving him feeling completely exhausted and financially defeated. He realized that trying to beat the institutional systems at their own game was a mathematical trap. The transaction fees, the emotional stress, and the sheer unpredictability of short-term market movements were keeping him trapped on a financial hamster wheel. He needed a structural shift.
The turning point came when Mark discovered a comprehensive, long-term study reviewing the performance of active Wall Street fund managers over a 15-year period. The data was clear and undeniable. Over 85% of professional investors, despite having supercomputers, insider access, and Ivy League degrees, failed to beat a simple, unmanaged index fund. This realization was a massive shock to his system. If the multi-million-dollar professionals couldn't consistently predict market highs and lows, why was he wasting his limited time and mental energy trying to do it? He decided to completely automate his approach, taking human emotion entirely out of the equation. He committed to a strict, unyielding system, investing exactly $500 every single month into a broad, low-cost index fund, completely regardless of whether the market was hitting record highs or crashing into a recession.
This is where the magic of dollar-cost averaging takes over. When the market is booming and prices are high, Mark's $500 purchases fewer shares. But when panic hits the news cycles and the market plunges, that exact same $500 automatically purchases significantly more shares at a deep discount. Over a multi-year horizon, this simple mechanic lowers his average cost per share naturally, transforming market volatility from a terrifying threat into his absolute greatest wealth-building asset. While his friends were panicking, selling at a loss, or trying to guess the absolute bottom of the market, Mark's automated system quietly executed in the background, working efficiently while he slept, traveled, and focused entirely on growing his primary career earnings.
But the real secret weapon that allowed Mark to scale his net worth into seven figures wasn't just consistency, it was the compounding effect of minimizing hidden financial leaks. Most retail investors unknowingly lose up to a third of their long-term wealth to high expense ratios, mutual fund fees, and wealth management percentages that sound small at 1 or 2%, but compound into hundreds of thousands of dollars lost over time. Mark strictly utilized index funds with an expense ratio of just 0.03%. By cutting out the financial middlemen and avoiding the tax traps triggered by frequent short-term trading, every single dollar he invested remained fully active, compounding exponentially year after year.
Let's look closely at the math behind this boring $500 monthly habit over a 25-year trajectory. Assuming an average historical market return of 10% compounded annually, a regular investor contributing just $500 a month reaches over $50,000 in the first 6 years. It feels incredibly slow at first, and this is exactly where most people give up. They look at their balance after a few years of discipline and think it isn't worth the sacrifice. But look at what happens next. Between years 10 and 20, the compounding engine enters overdrive. The interest earned on the accumulated balance begins to vastly outpace the actual physical cash contributions Mark is making from his salary.
By year 20, that simple $500 habit blossoms into over $340,000. And by year 25, the total surpasses an astonishing $668,000, with over $500,000 of that total consisting purely of compound interest generated by the system itself. If Mark scales his contribution slightly as his income rises, pushing it to $1,000 a month later in his career, the math accelerates dramatically, clearing well over $1.3 million. This is the precise financial blueprint that Wall Street doesn't want you to focus on, because it requires absolutely zero management fees, zero financial advisors, and zero active trading commissions. The psychological hurdle is the hardest part of this entire strategy. Human beings are hardwired to seek excitement, novelty, and immediate gratification. When the stock market experiences a severe correction, your natural biological instinct is to protect your capital and pull your money out. But true financial freedom requires overriding this survival instinct with raw, data-backed logic. When you look at the historical trajectory of the United States stock market over any rolling 20-year period in history, the probability of losing money is exactly 0%. The system is designed to reward structural patience and severely punish emotional reactivity. Mark mastered the psychology of wealth by treating his investment contributions exactly like a non-negotiable monthly utility bill.
Let's break down how you can set up this exact same system within the next 20 minutes. The first step is selecting a reputable, low-cost brokerage platform that offers automated investing features. You want to completely eliminate the need to manually log in and place a trade every month, because every manual step introduces a point of failure where your emotions can intervene. You configure the system to automatically withdraw your designated investment amount directly from your primary checking account on the exact day you receive your paycheck. By paying yourself first, you force your lifestyle to adapt naturally to the remaining balance, completely eliminating the temptation to spend your investment capital on depreciating liabilities.
The second step is asset allocation. Instead of trying to guess which sector will dominate the next decade, whether it's tech, energy, or healthcare, you buy the entire market through a total stock market index fund or an S&P 500 ETF. This gives you instant diversification across hundreds of the world's most profitable and resilient corporations. If one company fails, it is automatically replaced within the index by a rising competitor. You are essentially betting on the long-term ingenuity and productivity of the entire economic system, which has structurally trended upward for over a century.
Now, let's address the critics who claim that a $500 monthly investment is no longer enough to build substantial wealth due to modern inflation and rising living costs. While it is true that a dollar buys less today than it did 20 years ago, the underlying assets you own through index funds, real businesses, real estate, and corporate infrastructure naturally appreciate in tandem with inflation. When consumer prices rise, corporate revenues and profits increase as well, which drives stock market valuations higher. Therefore, owning productive equity is the single most effective, battle-tested shield against the erosion of your purchasing power.
To truly supercharge this system, you must also master the concept of tax-advantaged accounts. If you invest purely through a standard taxable brokerage account, you will face capital gains taxes and dividend taxes that chip away at your compound growth. By utilizing accounts like a Roth IRA or a traditional 401k, you can shield your investments from the IRS, allowing the full weight of your compound returns to accumulate completely tax-free. Over a multi-decade investing career, this single optimization can save you upwards of $150,000 in pure tax liabilities, directly accelerating your timeline to full financial independence.
Look at the profound psychological peace that comes with this level of financial automation. When you no longer rely on a single employer, a volatile asset class, or the whims of economic policy, your relationship with work and time completely changes. You stop viewing your career through the lens of survival and start viewing it through the lens of leverage. Mark didn't have to live an ultra-frugal life or sacrifice his happiness to achieve this. He simply built a predictable, bulletproof mechanism that handled the wealth creation for him, quietly in the background, while he enjoyed his life.
If you feel ready to leave the chaotic trading strategies behind, step away from the exhausting financial routine and start building a reliable, automated wealth system, hit the like button right under this video. This is my direct signal that we are perfectly aligned and ready to build something lasting and serious together. And of course, make sure to subscribe right now so you never miss the next critical stage of our long-term financial breakthrough series. We will continue to break down the hard numbers and actual case studies that provide true clarity.
The ultimate goal of the boring $500 habit is not just to see a massive number inside a digital bank account. It is to buy back your absolute most valuable, irreplaceable asset, your time. True wealth is the ability to wake up every morning and decide exactly how you want to spend your day, who you want to work with, and what projects you want to pursue without a financial gun pointed at your head. Stop chasing the volatile hype cycles. Stop letting Wall Street middlemen profit off your anxiety, and start building your automated empire brick by brick today. Your future self is relying entirely on the systematic decisions you choose to make right now.